Senate Tax Committee will come to order. We have a quorum present. First thing we will do is adopt the minutes from yesterday's meeting. Are there any comments, questions, or corrections? Hearing none, the minutes will stand approved as presented. First thing we're going to do today is there's been a request from Judiciary to hear Senate File 11, so I'll turn it over to Senator Rest for a motion.
Mr. Chairman, I move that Senate File 11 be taken from the table.
Heard the motion. All those in favor signify by saying aye. Aye. Opposed, same sign. Motion's carried. Senator Rest.
Mr. President, sorry, Mr. Chairman, I move that Senate File 11 be recommended to pass and referred to the Committee on Judiciary.
Very good. You've heard the motion. Any discussion? Hearing none, all in favor signify by saying aye. Aye. Opposed, same sign. Motion is carried. Senate File 11 is passed and hereby referred to Judiciary.
Mr. Chairman?
Yes.
Mr. Chairman, and the issue is we have reference to data practices in Senate File 11 as was presented yesterday, and the Judiciary Committee has jurisdiction over data practices, and so they asked to review it. Thank you very much.
And as you will recall, Senator Rest had previously indicated that our bills would primarily be laid over, but this being the request by Judiciary, we are moving this one forward. And I assume we would do that if any other requests similar to that will come in on any other bill. Sure. With that, we will turn to Senate File 268, Senator Nelson. Welcome to the committee, Senator. You may begin.
Thank you, Mr. Chair and committee, for hearing Senate File 268. And I want to also thank the co-sponsors of this bill, Senators Rest, Weber, and Dibble. Before we start, Mr. Chair, I do have an author's amendment. That would be the A1 amendment. I'd like to offer the A1.
Okay, is that in our packet yet? Okay. All right. Senator Nelson offers the author's amendment A1. All those in favor of the motion signify by saying aye.
Aye.
Opposed, same sign. Motion's carried. A1 is adopted. Senator Nelson, to the amendment and your bill.
Thank you so much, members. The bill before us deals with health care and helping lower the cost of some of those health care materials. In a nutshell, this bill would allow our private health plans to receive the same treatment that our Medicare, Medicaid, MA government plans receive when it comes to taxation on certain goods prescribed by a physician. With that, Mr. Chair, I will be glad to go through the bill, or would you like to hear the testifiers prior to my brief walkthrough on the bill?
Maybe you should go through the bill first, Senator, and then we'll go to your testifiers.
Sure. All right, just a couple things. It's a very short bill. In fact, Veterans on the Tax Committee, you will remember seeing this. It was part of our agreed upon tax bill in 2022. And again, this has to do with the healthcare materials. The first thing I want to say right away, especially for this committee, the Tax Committee, it is so important to note that this small change will not affect Minnesota's standing with the Streamlined Sales Tax Committee, and that's from our discussion in previous years. And so this bill will, as I said, allow the government-paid health care sales tax exemption for the same type of medical goods that our government-paid health care already allows. So this is a sales tax exemption. And The first thing that it does, it deals with the non-durable healthcare materials as prescribed by the physician would receive that same sales tax exemption. And Section 2 then also specifically adds that those transactions covered by a private health plan that are not already exempt would be exempt. And it goes on to describe what the private health plan is. So very simple bill, but has very good consequences for patients. So with that, Mr. Chair, I would be glad to turn it over to my testifiers to give a little bit more background.
Thank you, Senator. First, Ben Rachel,
Sir.
please introduce yourself for the record, and you may proceed.
Good morning. My name is Ben Rachel. I'm the CEO of Corner Home Medical, which is a durable medical equipment provider serving patients in the state of Minnesota. So I'm here today to share, so thank you for the opportunity to be here and share thoughts and answer questions. Our industry is an industry that provides services to patients in their home to maintain independence, essentially try and keep them in their home, reduce the cost, and improve their quality of life. So the sales tax laws do say if the item is to be used in the home, it's exempt. However, when tax audit comes, there are a lot of supplies and products that we provide that are confusing. So, and that's what I would say about the tax laws for DME providers. In one word, it's confusing. And so over the years, ourselves, Corner Home Medical, and our colleagues as members of the Trade Association MAMES are faced with tax audits that are often delivered to us with a shocking number. And then there's a lot of work that goes into identifying what's real and what should be paid out of that and what shouldn't. Our last tax audit was in 2020, so it was the year of COVID. And our tax audit that the estimated tax due was north of $100,000. And we spent almost 500 hours of our controller's time working with an auditor. And we wrote a check for $16,000. Actually, it was $17,008 because there was a 10% penalty on it. So the work that was done, we developed an internal document because previous to that, Corner Home Medical and many other suppliers have gone through these laborious audits and started with a number that was shocking and ended with a number that made more sense, but both the state and the companies spent a lot of money to get there. And so one of the things I recall in 2020 is we were debating whether gloves and PPE were going to be taxable or not. And that was during a pandemic. So, some of these things take a lot of work to get to the final result of what's taxable and what's not. We certainly want to do right by the state and by the patients and collect tax where it's necessary. But as I indicated, 95% of this work, these services and products are done for patients in the home. Not only that, but again, 95% of that is billed to an insurance party on behalf of the patient. So the transaction is with the patient, but the billing goes to the insurance company. There isn't an insurance company in the state that pays sales tax when we bill it to them. So we came, I think, a dozen years ago to talk through this, and the idea was exempt the business that's billed to the insurance companies because they don't pay it. And what that ended with was that the federal and state charges, or the things that were billed to Medicare or Medicaid or to private insurances that are assuming those responsibilities, so Medicare Advantage plans and prepaid medical assistance plans, we exempted them at the time. What didn't get included in the exemption at that time was the other health insurance plans who won't pay the tax. So it ends up, in all reality, being a tax on the provider. The patient doesn't pay it, and the health plans don't pay it, so the provider has to pay it. And it's really confusing, and if you don't mind, I have a couple of props. But there are things that are clearly taxable or non-taxable, and there are things that aren't. So many of you know this is stethoscope. Many would think that's a taxable item. In the state rules, it's not taxable. This is a bedpan that typically is going to be used in the home, and this is and durable, continued use. There's questions about whether this is taxable or not. So it's that level of detail that we have to go through in hundreds of thousands of transactions with a tax auditor to come to what's the reality of what tax should be paid, and to show that the health plans simply don't pay the tax. Again, I'm thankful to be here to present. Appreciate Senator Nelson's leading on this issue. We're just trying to get out of this penalty as a provider and exempt the insurance company that's not going to pay that tax.
Thank you, Mr. Rachel. Next, Mr. Bill Amberg, welcome to the committee. Please identify yourself for the record.
Thank you, Mr. Chair. Bill Amberg, Amberg Law Office. I represent Corner Home Medical here at the Capitol. But as Mr. Rachel mentioned, we're also here on behalf of our colleagues from MAMES and the broader industry. This law was originally passed as Streamlined Sales and Use Tax Agreement in 2007. And I'm just going to make a couple of points and try to anticipate some questions, because I think this is about the 20th hearing we've had between the House and Senate over the years. This isn't a situation where a typical merchant, you go to Target and you want to get an iPhone. If you refuse to pay the sales tax, the merchant is acting on behalf of the Department of Revenue, collecting that sales tax. In healthcare, products that Mr. Rachel just pointed out a few examples are given, fitted, delivered to the patient, and typically in healthcare, they're not billed for 30 days. And as he pointed out, government insurers, which this committee in the House exempted about a dozen years ago, but they're under no obligation to pay retroactively, so it ends up being a burden, including not just the administrative expense that Mr. Rachel highlighted, but very often, they're paying it out of the pocket because the consumer patient and the health insurer is under no requirement to pay. That's why this has been such a vexing issue over the years. The items that Mr. Rachel went through, this is less than 1% of all the products and services and supplies that are provided. So it's a very small piece of what they do. One question that we've got in committee in the past is there's many other states that are members of the Streamlined Sales and Use Tax Agreement, as is Minnesota. The only state that we know of that chooses to collect this tax this way is California. But California reimburses the providers, like Corner Home Medical, for that. So that relieves that administrative burden to the state, with an auditor. And I think that 2020 audit, I think it was a full month.
The length of time it was beyond that.
Yeah, it was over a month. And at Corner Home Medical, we're one of the larger providers. One of our colleagues, probably the first or second largest, similar timeline, their tax bill was in the hundreds of thousands. They ended up paying $13,500, again, after their CFO, controller spent that month or more with the auditor in this back and forth kind of educating auditor. But many DME providers, particularly in greater Minnesota, are smaller operators with 10, 15 employees. So typically the owner operator is going to have to sit down, and they just don't have the time to go line by line. And so some of our smaller members of the home medical community end up paying a higher tax bill than some of the bigger operations. And that's certainly a strain, and we've lost quite a few of these who have gone under for a lot of other reasons, not the sales tax, over the last decade in the state of Minnesota. So I'll leave it there for now.
Thank you. Questions? I have seen none. Senator Nelson, any final comments?
Yeah, just very briefly to note that this would also bring some parity in our tax code as far as how we treat those private health plans and our government-paid health plans. And also to note that you might wonder, well, why don't we just clear up our law so it's not as vague? But the issue is these products are ever-changing, healthcare is ever-changing, new items continually to come on the market as well. And so it's important that we just be consistent in how we exempt sales tax on these type of durable medical goods. So I would ask the committee to consider this for a potential layover. Just to give you two things to take on to, there's the MAMES letter, which is from the Midwest Association of Medical Equipment Service and Supplies. That gives you a little bit of background. And if you're like me, you're wondering, well, what is it? Which things are exempt and which ones are not exempt? You have a sheet in your folder that kind of describes a little bit of the complexity of that. But I would ask that the committee consider this for possible inclusion, and thank you for your hearing today.
Thank you, Senator Nelson. With that, Senate File 268, as amended, will be laid over. Next, we go to Senate File 88, Senator Klein. Welcome, Senator Klein. I'll note you also have an A1 amendment, a simple word change.
Mr. Chair, thank you for hearing Senate File 88. I offer the A1 as an author's amendment.
Senator Klein moves A1 amendment. All in favor signify by saying aye.
Aye.
Opposed, same sign. Motion's carried. Amendment is adopted. Proceed.
Chair and committee, thank you so much for hearing Senate File 88, which we also heard last year and was briefly included in the final tax bill. This Senate file, I think my co-author, Senator Drazkowski, attempts to correct a problem that we've heard in this committee repeatedly, which is that our business owners, our constituent taxpayers will believe in good faith that they are following existing tax policy and they have been subjected to an audit and are trying to abide by that audit, and then suddenly have an additional tax burden, sometimes retroactive, based on a reinterpretation of tax law by the department. And Senator Dibble had a story about a school district. I had a story about a business within my district that was similar. So I worked with the department last year in an effort to try to address this and make sure that the legislature sort of has the control over reinterpretation of tax law and assessment of tax burden on businesses, and came up with Senate File 88. The language, I will admit, is a little confusing, and people have come to me to sort of make sure I am accomplishing what I want to do here, but essentially it requires that the Commissioner of Revenue cannot issue assessments for additional income tax or sales tax if the two requirements listed in the bill are met. The first is that the taxpayer was given erroneous advice previously and they relied on that advice in good faith. And then the second provision is, I want to be quite careful about the language here because people have asked a lot of questions. Neither the statute or administrative rule on which reporting or other practice is based has been materially changed. Its interpretation has not been changed by a court decision, or there has not been a federal adjustment on the tax return. So that's where we have sort of legislative power over it. And then, not only those things have to occur, but the commissioner has not issued a revenue notice or directly notified the taxpayer in writing of the commissioner's position regarding the reporting. So this is a limitation on the power of the Department of Revenue to reinterpret tax statute. And I'm just going to pause before I go to testifiers, Mr. Chair, to ask a question on the record of Ms. Pollack, because it's been asked of me. Some people who read your bill summary and read the bill were concerned that tax assessments could be changed by the Department of Revenue simply on the basis of issuing a new revenue note. I've read the language quite carefully, and I think that is not the case, but can you clarify that, please, for the committee?
Ms. Pollack?
Mr. Chair,
And Senator Klein, that's correct. The way that you described the language in, starting on 1.19 is correct. So there are kind of two prongs. The first prong has three issues. Any one of these has to have been met. So the statute or rule on which the reporting practice is based has not been materially changed. The interpretation of the statute or administrative rule has not been changed by a court decision, or there has not been a federal adjustment on the tax return. So any one of those three things, and the commissioner has not issued a revenue notice or directly notified the taxpayer in writing of the different treatment of the income or sales tax item.
Mr. Chair, that's the bill, and I have testifiers.
Okay, very good. We have listed Joanna Bears from the Department of Revenue and Mr. Gino Fragnito. So, Ms. Bears, welcome.
Mr. Chair, members of the committee, for the record, my name is Joanna Bears. I'm the Legislative Director at the Minnesota Department of Revenue. And I appreciate Senator Klein's comments, and he summarized the bill accurately. We don't have a position on this bill, but I did want to provide an example where it talks about sample audits, because I know that has been a big question for a lot of folks about what a sample audit is and how does it apply. So I did want to provide a quick example the way it works. So in a sample audit examines a representative subset of a population rather than the entire population. And at the department, we do a couple different sample audits. It really depends on the situation with records and things like that, and the type of audit that we are doing. If in a sample audit, if the issue was not present in the sample, we audited, and years later, another audit was conducted and the issue was found, the taxpayer could not rely on the previous audit to claim they received erroneous advice because the issue was never addressed in the previous audit. However, if we did address it in that sample audit, then they could use that as a basis to claim the relief. So for example, consider a store that sells food, electronics, clothing, cards, and gifts, appliances, and furniture. They have thousands of products for sale. The store uses a tax matrix, which is a list of sales transactions along with a product code. The product code is matched with our sales tax laws. Certain products are coded as taxable and others are exempt. During the audit period, the retailer mistakenly coded honey roasted nuts as food and sold that product from tax, or sold that product exempt from tax. And at that time, they did not sell many honey roasted nuts, and the product didn't come up in the sample we looked at. So we issued the assessment for other items that were sold exempt that were taxable under our laws, but we missed that one because we did not look at that in the sample because it did not come up in the sample. Now, years past, the retailer reviews its sales tax matrix on a regular basis. New products are introduced, and the retailer even reviews our fact sheet on candy, which lists honey roasted nuts as a taxable candy. Even so, the retailer does not change the code. Years later, the department returns for another audit, and this time we notice honey roasted nuts. In this situation, the department would assess the tax because the issue was never addressed in the original sample audit, and our fact sheets correctly stated honey roasted nuts were considered candy and subject to tax. Now, if you take the same situation, if the honey roasted nuts were included in our sample audit originally, but we never addressed the issue for some reason, we missed it, or it was never addressed, and years later the taxpayer received an audit from us and we caught the issue, the taxpayer would not be assessed the additional tax for that specific issue, but would be required to correct the tax going forward. So that's just one example with a sample audit. There's other examples that you could take with a traditional audit, but we're happy to answer any questions that folks may have on that, or members may have on that.
Very good. Thank you, Ms. Bears. Before we proceed to Mr. Fragnito, Ms. Pollack has noted that the amendment maybe needs a rewording. So at this point, Senator Klein moves to reconsider the A1 amendment. All those in favor signify by saying aye. Aye. Opposed, same sign. Motion's carried. To Ms. Pollack for the new amendment.
Mr. Chair and members, it was just pointed out to me that on page 1, line 21 of the bill, there are two instances of the word has. And so this oral amendment to the A1 would just clarify that the insertion is after the second has. So on line 1.2 of the A1 amendment, the amendment to the A1 would be on line 1.2 after after insert the second.
But the A1 amendment has to come back before us, though, in order to do.
Reconsideration.
Yeah.
Yeah, we did that.
I'm sorry.
Yeah.
Okay, yep, absolutely.
Okay, very
we got
good.
it right.
Any questions concerning the new amendment? If not, Senator Klein moves the A1 amendment as amended. Discussion. All those in favor signify by saying aye. Aye. Opposed, same sign. Motion is carried. Now, Mr. Fragnito, welcome.
Thank you, Mr. Chairman and members of the committee. I'm Gino Fragnito. I'm the Government Relations Director at the Minnesota CPA Society, and we're here today in support of Senate File 88, and thank Senator Klein and Drazkowski for introducing this bill, a bill that would provide some certainty and relief for taxpayers who believe they were doing the right thing by following the recommendations resulting from a Department of Revenue audit. CPAs and the clients they work with rely on the guidance from tax administrators to make decisions so they collect and remit the proper amount of taxes, no more, no less. Taxpayers want to do the right thing and remit the correct amount of tax owed. One would think that the direction from an auditor would be sufficient guidance, and if followed, the taxpayer would be able to correctly remit future tax payments. Mr. Chair, members of the committee, that's not always the case, and my members continue to express frustration about inconsistent interpretations and application among auditors at the department. And far too often, we continue to hear taxpayers who were audited maybe 3 or 6 years ago may or may not have been assessed additional tax and were provided guidance on how a particular tax was to be applied in the future, only to be audited in the future after that and find out with a new auditor or a department had a different interpretation. So the taxpayer is now faced with potential penalties, interest, back taxes because they did what they were instructed to do in a previous audit. No one should be left to wonder if they will be assessed back taxes for following the past interpretation and guidance, provided there has not been a rule or a statute change or a federal adjustment change. Senate File 88 will provide some reassurance while also giving the department flexibility in how the law is applied prospectively. As this bill progresses, I would also suggest that there are other tax types that could be considered, such as those in Chapter 295, where there could be audits with similar patterns. In closing, Mr. Chair, consistent application of the law and tax guidance from tax administrators is required so taxpayers can be assured they are properly complying with the laws. Thank you.
Thank you. Any questions, members? Senator Drazkowski.
Thank you, Mr. Chair. Thank you for the bill, Senator Klein. Ms. Bears, if this passes into law, what will the department do differently at that point in these situations? Can you kind of outline what the department's response would be? And I mean, as a taxpayer, I would see, okay, if this is into law and the department still doesn't, recognize it, what do we do? So what will the department do differently upon enactment of this language?
Ms. Bears.
Mr. Chair, Senator Drazkowski, that's a good question. So right now, the audit notice already requires to list specifically on the audit what's included, but we will be much more detailed about what this audit includes and what it doesn't include in there, and we'll provide guidance much more in writing. We'll get folks so that they know what the law would be or what would apply and when it would apply. When it comes to normal audits in general, there wouldn't be much change, but we would make sure that folks were much more aware of if something changed and when that changed.
Any other questions, members? Yes, Senator Dibble.
Thank you, Mr. Chair. Ms. Bears, I was slightly confused by your testimony. Just need some clarification. Were you expressing concern that the circumstance you described would occur should this bill be passed, or were you describing matters as they are today?
Ms. Bears.
Senator Weber, Senator Dibble, I think I would just use as an example. So there are times where things might be missed. We hear from taxpayers where they felt that a treatment was given at one point and then it was different. I'm not aware of everything that happens, but we do try to be as transparent as possible, and we are working on making sure folks know exactly what is taxable and what's not taxable and what their rules and obligations are. And so I'm not sure if that helps answer the question, but, I think I was just using this as kind of an example. If something did occur, this is how it would apply.
Senator Dibble?
And I understand that, and I think this bill is written to address that circumstance in that situation. I think this bill is written to capture those circumstances where clearly the taxpayer was acting in good faith based on information that it had received from the department. That's certainly the story that I have told many times in this committee, where my constituent received direction, went back and got clarification, had everything in writing as clear as a bell, and then the department changed its mind and then went back and captured tens of thousands of dollars in what it deemed to be unpaid back taxes, which, fortunately the taxpayer was able to enter into negotiation and cut that bill to some degree. But in my view, they shouldn't have had to pay 1 penny. They still suffered a fairly consequential impact to their business. And if you read the record, it is quite clear that they were given wrong, it was not given wrong information, they were given correct information, which the agency then decided to change its mind in a future year and treated all of those transactions retroactively. And then resisted my efforts to change the law. At that point, I was, a junior member, not nearly as powerful as Senator Klein, so hopefully we'll get some, and didn't have the favor of the then tax chair, and so hopefully we'll get some traction this year. Thank you, Mr. Chair.
Thanks, Senator Dibble. First Senator Klein and then Senator Nelson.
I'll save my comments to closing.
Okay. Senator Nelson.
Oh, thank you, Mr. Chair. Senator Klein, this is a great bill. Thank you for writing this. I think it is a taxpayer bill that allows taxpayers to follow what they have been told, understood. We understand things change over time, but this protects the taxpayer. It reminds me a little bit of a piece that was in the private letter ruling, and I think this is actually an improvement on that private letter ruling, because the department is here to support this bill, which actually would prevent the need for the private letter ruling. So again, I think this is a great taxpayer protection plan, and I appreciate you bringing this. Senator Klein, I've already sent a note to the front desk. If you have room for another co-sponsor, I'd be glad to co-sponsor with you, but very nice. Thank you so much. And thank you for the department for coming up to work through this. Thank you.
Senator Rest.
Thank you, Mr. Chairman. I certainly support the intent of the bill and the provisions that are in it. I don't know whether it actually addresses what is currently happening. And contrary to Senator Nelson, I don't support and have expressed my opinion very vigorously to Mr. Fragnito, private letter rulings. We have revenue rulings that the department has to depend upon, and that guide the department. They do not guide the taxpayer, who can object to them under all circumstances, as far as I know. But I'm curious about whether in the last year, when this issue really came before the legislature, and Senator Klein, I don't remember if it was your bill before. Mr. Chairman, was it your bill before?
Mr. Chairman, Senator Rest, it was my bill.
Yeah. So since that bill last year was heard, has the department been informed of any action by the department that wouldn't already be in accord with the provisions that are in Senate File 88? Just curious.
Ms. Barris?
Maybe we need it, maybe we don't.
Senator Rest, or Mr. Chair, Senator Rest, I'm not aware of anything specifically. I do want to say that this would provide consistency among the department. So this isn't necessarily something new. We can do this, but it would require to do litigation or some type of settlement. This piece of legislation would bypass that settlement or litigation where an auditor could then make that determination. And so this would already kind of happens, but it happens down the road of settlement litigation. But I'm not aware of any situation occurring right now. I would have to go back and check with our staff.
Okay, thank you.
Senator Dibble.
Well, thanks. I just have to respond to Ms. Bayer's point. She said it would bypass a settlement as if though that were a bad thing. That, in my opinion, would be a good thing, particularly in the case of the story that I tell. My constituent was forced into a negotiation over money they should never have owed in the first place. And this sets forth the policy in the sense of the legislature that these things shouldn't happen. And people shouldn't be forced into that posture vis-a-vis the agency. Thank you, Mr. Chair.
Thank you. Any further comments? Oh, Senator Drazkowski.
Thank you, Mr. Chair. And maybe just to remind the members, in the last biennium, we didn't see this conflict, Senator Rest, happen just once. It was multiple times before this committee. I remember speaking out about them at least 3 times in this committee in the last 2 years with the department. And I don't know that they're all perfectly related, but I think Senator Klein's bill does a great job at starting to send that message to the department that they can't be schizophrenic in the face of a taxpayer. They have to actually work in the interest of the taxpayer with the information they've been provided. So I think it's a really good bill, and I would just encourage you, Senator Rest, Madam Chair, to take a really good look at the need for this. Thank you, Mr. Chair.
Anything else? Seeing no other request, the Senate File 88 as, Senator Klein, excuse me, final comment. I'm sorry.
Thank you so much, Mr. Chair. I do have a couple of comments. I try not to be too talkative, but first of all, I do want to thank, you'll notice a letter in your packets from the Chamber of Commerce who supports the bill, and obviously Mr. Fragni, I want to thank him. And I also want to thank the department. You know, this bill may seem like a sort of an attack on the department, and maybe that hostility came through in this hearing, but they worked with me very closely on getting this right. I think they stand to benefit from responsible tax approach to consumer, and Commissioner Marquardt was very helpful in the language of this bill. Last year, I learned something about data sampling, and this is what Joanna Bayers was trying to represent to the committee. When I first introduced this bill, it had a very large fiscal note, and the reason for that is that a lot of these audits occur by sort of data sampling, and the department felt that if they were sort of held to rigorous standards on these audits and couldn't change their mind later, they would have to sort of stop doing data sampling and audit every single item on every single store shelf. And so that initially had a very large fiscal note. I worked with the department and kind of made accommodations for that practice within this bill. We still don't have a revenue estimate or a fiscal note on this bill. I am hopeful that it will be small or negligible, but we await it. And thank you so much to the committee for giving it consideration.
Thank you, Senator. With that, once that fiscal note does become available, or the revenue estimate, that will be shared with the committee. So with that, Senate File 88, as amended, will be laid over. Thank you. Next, we will turn to Senate File 33, Senator Rest. Welcome, Senator, when you're ready.
Thank you, Mr. Chairman and members. Senate File 33 is where we're starting, correct?
Yes.
Yeah. deals with property tax classification. It has come to be called simply 4D because that's where it is in the statutes. It was a program started in the late 1990s to find a way through the tax system to encourage developers to undertake low-income housing for a, quite frankly, a tax break in the classification of the property that was being built. And it is, it's been in place for some time, as I've indicated, but over time, we also have been responsive to changes in the development community and also in the folks that are scheduled to rent in those buildings that are making use of 4D. And you can use 4D under a number of different programs. What is mostly used for currently is tax credits. But what this bill that proposes to change, and I will go through it, is how you get to the qualifying percentage that allows the 4D classification to operate. And simply stated, it's an income averaging of the renters, rather than having a specific percentage that has to apply to all the units. So if you look at page 1, it's not a very long bill, but if you look at page 1, it first of all is the 4D statute, and it refers to the units that are subject to housing assistance payments, and also that they are rent restricted and income restricted units. This is in paragraph 2, line 112, of qualified low-income housing projects that receive those tax credits. And so when you get to point 4, beginning at 117, is the requirement of presenting the documentation that you actually are, the developer is actually qualified. And starting with line 120, that the rent restriction and income restriction says at the time of initial occupancy, and this sometimes does become an issue when a unit has qualified and then the renter has an increase in income. But right now, and we're going forward with this bill, that it doesn't exceed, I'm looking at line 121, 60% of the greater area AMI, adjusted for family size, as we often do, and then how that is determined, and also that it requires the rents not exceed 30% of 60% of the greater area AMI. And what this allows is a income averaging in the determination of the eligibility of those units. it is not any more, quite frankly, any more complicated than that, or at least in my mind, it's not. So I hope that you will consider it favorably. We had it in, it's no different than the bill that we had last year that was included in the Senate tax bill, except for updating the effective date.
Thank you, Senator. Any questions? If not, we have Mr. Innes for a testifier. Welcome, Mr. Innes. Please identify yourself for the record.
And thank you, Chairman. My name is Ward Innes. I'm here on behalf of the 4D Affordable Housing Coalition. That coalition is comprised of both for-profit and nonprofit affordable housing developers. They're responsible for developing approximately 80% of the affordable housing stock in the state of Minnesota. And they've been very much involved with Senator Rest's discussions over the last few years with modernizing and updating the 4D program. We appreciate her continued leadership on this issue. I think the most important thing I can say on the record here is that the bill in front of you does nothing to expand the 4D program. It is simply clarifying and conforming language that is consistent with MHFA's current interpretation of the income averaging statute. There's a number of attorneys that operate in this space that thought some clarification was needed just to make sure everybody was comfortable that it did comport with the current law. But this is consistent with MHFA's current interpretation and just simply is clarifying and conforming language. Income averaging will be a very important piece moving forward. I think we've all agreed that more affordable housing is needed and more deeply affordable housing is needed. And so the income averaging facilitates that by allowing 80% AMI units to be built in conjunction with 30% AMI units, as long as they average out in their entirety in the building to 60%. So it tries to try to facilitate the development of more deeply affordable housing units. And so that's, this change came about at the federal level in 2018. MHFA has been in compliance with that. This is just conforming and clarifying language to make sure everybody's comfortable that it is allowable under current law. I don't know of any opposition. The League of Minnesota Cities believes it's also technical in nature. I know it was heard last year in this committee without incident and without controversy. So I think it's just simply, as I stated, a clarifying legislation.
Members, any questions? Seeing none, Senator Rest, any final comments?
No.
Okay. With that, Senate File 33 will be laid over for possible inclusion.
Thank you.
Next, Senator Rest, Senate File 6.
Thank you, Mr. Chairman. This bill attempts to clarify and to determine the definition of a resident trust separate from a grantor trust, using the years 1995 as a determinative factor about how resident trusts are going to be treated under Minnesota tax code. It is greeted with skepticism by the Department of Revenue, and there are ongoing discussions about the determining factors of what should determine a resident trust. And this also even goes to the whole discussion of who's a resident, period, in Minnesota, subject to income tax. And as you know, there's a whole list of factors, and we've discussed them over and over. And we still don't have, perfect agreement with the way in which the department treats people with regard to do you live here, or do you live, I'm trying not to interject a phrase here, but, or do you live in Florida? And, sorry. And so do you live here more than half the time? Do you do your banking here? Or do you do it elsewhere? Do you, where's your attorney? Where's your accountant? And where's your driver's license? And all kinds of requirements or actually descriptors of what would determine that you are a resident and subject to Minnesota income taxes. Well, the same kind of discussion goes over to trusts, and whether it's a non-resident trust or a resident trust, and how should it be taxed. And the so in this bill, in section 1, the definition is suggested that a resident trust is a trust that, except for a grantor trust, that had become irrevocable on or before December 31st, 1995, or was first administered on or before that same date. If just 2 of the 3 descriptors are in place, that most of the, so this is what's leading to, as I understand it, where it would be clearly taxed in Minnesota, that a majority of the discretionary decisions of the trustees about where investments are made in Minnesota. That's one. Secondly, that a majority of the, again, discretionary decisions of the trustees are made, determined by where the trust income is distributed. And then the records, the meetings, the minutes of those meetings, the accounts, the records are also located in Minnesota and not elsewhere. So 2 out of those 3. And then, secondly, that a trust, again, that became irrevocable, again, that magic date, December 31st, 1995, or first administered after December 31st, 1995, is a resident trust only if, first of all, it was created by a will of a decedent, that it was secondly, an irrevocable trust, and then, once again, those 2 qualifiers are brought into this definition as well, and the same qualifiers, and that 2 or 3 of them are met. So that's the bill. What's the effect of it? The effect of it ends up being, from the Department of Revenue, that $4.7 million in the first year, and then ongoing in the in 27, 28, and 29, with an increase, would be a revenue loss to the state of Minnesota, because there would be more trusts that would claim non-resident status and therefore not be subject to Minnesota taxation. There's a Supreme Court, if you look at the revenue estimate, there's a Supreme Court case called Feeling that is referenced in the revenue estimate, and it applies the same definitions, requirements, both to the pre-1996 trusts, and then also applies a similar definition, which is in the second part of it, to a 1995 trust. I think the current, and I'm hoping Senator Klein and Senator Drazkowski, Senator Dibble and Nelson, who spoke about Senator Klein's bill, see the same kind of inconsistency and clarity needed for when a trust should be affiliated with a Minnesotan resident, and when it should not be, and that if that means that there is a revenue loss, it seems to me it also means that we needed this clarification of this definition. So whether we can achieve this, that's $11 million for the biennium. I don't know whether this is the year or not, but I'm going to continue to advocate for it until we can reach some sort of understanding of when a Minnesotan is going to be taxed here and when they are not.
Very good. Thank you, Senator. We have testifier Michael Sampson. Would you please come forward and identify yourself for the record, and then you may proceed. Thank you.
Thank you, Mr. Chairman. Michael Sampson. I'm an attorney at the Minneapolis firm Maslin LLP. I represent individuals and trusts as taxpayers in Minnesota. As Senator Rest mentioned, the question about whether an individual is a resident of Minnesota and required to pay taxes here is one that has many factors that the department considers. One of the advantages of that is that those factors are set forth in a regulation. There are 26 factors. They're numbered A through Z. I think the reason there are 26 is because we have 26 letters in the alphabet. If there were more letters in the alphabet, there'd be more factors. But what's clear is we have a black and white list of factors. We can tell taxpayers these are the things that they will look at, and you can act accordingly. Trusts are taxed like individuals, but it's harder to tell where a trust lives than a human being. And what we have to do then is look to where the trustees are, because the activity of a trust is carried out by its trustees. And it's right now, because of the Fielding case, the Fielding case said you can't simply tax a trust as a Minnesota resident because the person who set it up was a Minnesota resident, which is what the rule currently says. That's not enough contact with the state to justify taxing it. But what is enough contact is simply not clear. It simply says there has to be some minimum contact. And this uncertainty, the lack of a list of connections or any kind of clear guidance, it favors the Department of Revenue, frankly, because they say, well, just tell us all the connections that you have and we'll let you know whether that's sufficient or not. And it creates the question as a taxpayer, do I advise my client to file a tax return or not if I'm not sure whether they should have to? A practitioner friend of mine says you shouldn't have to be a constitutional scholar to file your taxes. And that's really the situation we're in right now. The proposal on the table makes it quite clear that the trust being administered in Minnesota is determined by whether the investment decisions or the distribution decisions, the two key decisions trustees make, are made here by trustees who are here or made somewhere else. And by looking to those objective rules, it's possible for taxpayers to read the statute and say, I do or I don't have a filing obligation. They don't have to consult a lawyer and read the Constitution and decide whether they have sufficient contacts. So creating this clarity is beneficial. It will make it possible to decide, do I need to file or not? And that may end up resulting in fewer trust returns being filed because it's clear that this trust isn't required to file. But that clarity is valuable, and I think the bill does a good job of addressing that.
Thank you. Senator Rest, based on the testifier's testimony, I assume you are not expanding the alphabet for the purpose of this bill, correct?
Well, in years past, when we had levy limits, we went way into the doubles on the alphabet as exceptions to levy limits. But no, I think 26 is sufficient.
Very good. Any other questions, members? Yes, Senator Drazkowski.
Thank you, Mr. Chair. Certainly, Senator Rest, an area I haven't studied a lot of law, but I'm wondering what happens with interstate disagreements about who's going to tax the trust. So we've got the definition that was outlined, that's outlined in the bill and was described to us now, where if the person who set the trust up is in Minnesota or was in Minnesota, it would be taxed here. What if the trustees at the same time lived in the state of Iowa and had the language in Iowa that's in your bill? Are the two states going to fight over who they're going to tax, or how does that get sorted out just generally in the U.S.?
Senator Rest.
Mr. Chairman, Senator Drazkowski, I'm not certain I understand exactly, but if the state of Iowa had in its law the provisions of this bill, it would mean that merely being the trust merely being put in place by an Iowa resident also would not make it taxable in Iowa. It would be a non-resident trust, and well, if all those decisions, 2 out of those 3 qualifications, those actions were made by the trustee in Minnesota, then it would be taxable here, I suppose, but not taxable. But, well, I'm sorry, it'd be the other way around. It would be taxable in Iowa if those decisions and those distributions were made outside of Iowa. It would be a non-resident trust in Iowa. If 2 of those 3 were made in Iowa, it would be taxed to the extent that Iowa taxes trust income. Do they?
I suspect they do.
Anyway, if they did, then it would be taxed as a resident trust in Iowa.
Senator Drazkowski.
So, Mr. Chair,
I don't think Mr. Chairman, Senator Drazkowski, I don't think the variances in the state law is a determinative factor. Is it, do you think?
I'm just trying to understand how it would be treated differently in different states. So if we've got one definition here that we currently have in law, and say Iowa adopted the language in your bill to describe their law of what a resident trust is, and the 2 out of the 3 different measures here, if they had your bill in Iowa that was that determined that was their law in Iowa, and we had our current law here in Minnesota.
Oh, I see.
Are the 2 states going to fight over that trust, or how? I would guess that is.
I don't know.
How does that get rectified?
Go ahead. I'm going to defer to him. I don't know the answer.
Yes,
to that.
Mr. Sampson.
Mr. Chairman, Senator, there are credits in the tax codes. So if you pay this, for example, California has a rule that if the trustees are resident in California, then you pay tax to California. If that same trust were also taxed to Minnesota, you would pay the tax to the higher state, and you'd get a credit for the tax you paid in the other state. And so if the tax rate is 11% in California and 10% here, you'd pay 10% to Minnesota and 1% to California, and then you'd get a credit for the tax you paid here, and vice versa.
So you don't have to, Mr. Chairman, Senator Drazkowski, based on that explanation, you don't have to pay tax twice on the same income earned by the trust.
That's helpful. Thank you, Mr. Sampson.
Yes.
And that brings clarity. Thank you. Thank you, Senator Rest.
Any other questions, members? Hearing none, Senator Rest, any final comment?
Nope.
With that, Senate File 6 will be laid over for possible inclusion.
Appreciate it. Yeah.
Members, our next bill up is Senate File 245, and that's Senator Weber's bill. Senator Weber, House Senate File 245.
Thank you, Mr. Chairman. This bill is a bill actually that I thought, for a problem I thought I had corrected once before. And this deals with the definition of family member for real estate tax purposes. A number of years ago, the state allowed a homestead to be given for extended family, for example, and that included lineal descendants, the child, parents, grandparents. And so what we were seeing in a previous term, I served as the chair of the Ag Committee, and as a member of that, I served on MALC, which is the Minnesota Agriculture Education Leadership Council. And one of the issues, and they deal with the adult farm management program in the state of Minnesota as well. And one of the issues that arose is actually difficulties that we have in the transfer of the family farm to the next generation. As we have seen values escalate, we see incomes still vary a great deal, which has always been typical of the farm economy. It sometimes becomes very, very challenging to get that farm transferred from generation to generation. And one of the issues that is out there is that we see a lot of times family farm partnerships where you have siblings that farm together, and as a result, they go ahead and own property together. And when one of the siblings retires, perhaps they have no children that are entering into the business, but children of the other sibling are. But as an uncle or as a cousin, depending on how the farm has transferred, or that may have happened to death, due to death, they get no benefit from the homestead credit. And so a couple years ago, I had a bill that expanded the definition of family to include uncles, cousins, et cetera, and thought that we had taken care of the problem. Well, what happens is that as you try to ensure the transfer of property, you start to sell parts of the farm, a lot of times a building site, to that nephew or niece who is coming into the operation. When that happens, they of course qualify for homestead on their portion of the property, But that transaction kicked the uncles and cousins out. They were no longer considered qualified. I don't understand why, but they weren't. And so this bill attempts to rectify that situation. And basically, the bill itself has very few changes, except if you go to page 2.7, 2.8, it now defines the owners, the definition of owners, and includes uncle, aunt, nephew, niece, along with the parents, grandparents, and what have you. So with that, Mr. Chairman, I am told that that will take care of the issue that is out there, and that this would be effective starting to real estate taxes payable in 2027. And the revenue note that is included has an unknown factor, but it is considered to be very small. And with that, I have representatives here from Minnesota Farmers Union and the Minnesota Farm Bureau to testify on this bill.
Thank you, Senator Weber. Mr. Laurie, would you like to go first? If you'd introduce yourself and proceed, sir.
Absolutely. Thank you, Chair Drazkowski and members of the committee. For the record, my name is Stu Laurie. I'm the Government Relations Director for Minnesota Farmers Union, and glad for the opportunity to share our support for Chair Weber's SF 245 to expand the definition of qualifying relatives for ag homestead. Specialty ag homestead can be complicated to apply for, but the bill is relatively straightforward, and so I'll try to keep my testimony brief. First, broadly, ag homestead is, in our view, the foundational tax benefit that keeps farmland affordable for family farmers, folks who work the land, right? And as Senator Weber laid out, there's a challenge when often the more senior generation wants to move out and make room for the next generation, which is something that we want to encourage, get more young farmers on the land, when they then incur what they view as a tax penalty because they lose that homestead tax credit. And so the specialty ag homestead credit is important because it allows families to maintain that credit and transition that farm, which is often complicated and costly. This change would clarify that list of qualifying relatives, those folks who, if they're working that land, and in the case of the bill, it's clarifying that if it's unoccupied land, if they're working that land, then that often senior member of the family can maintain that tax benefit. From a user perspective, and I'll admit, I think this won't affect a ton of families, but for the families who are interacting with it, it's going to be really important for them, and it's going to make this credit more consistent and streamlined. And finally, I'll just say, thank you, Senator Weber, for your continued work on this, to the committee for continuing to work to strengthen the homestead tax credit, and I'd be happy to answer any questions. Thank you.
Thank you, Mr. Laurie. Mr. Peterson, would you like to introduce yourself and proceed, sir?
Thank you, Chair Drazkowski. My name is Hunter Peterson. I'm the Public Policy Specialist for Minnesota Farm Bureau Federation. I have the privilege of representing over 31,000 farmer and rancher members from across the state. Thank you for the opportunity to testify on Senate File 245, which expands the relatives eligible to actively farm in unoccupied property under the Special Agricultural Homestead. Our members value farming and ranching as a family enterprise. We recognize that family farms and ranches take many different shapes, often involving extended family or step family members like those enumerated in this bill. The Special Ag Homestead plays a really important role in preserving and transitioning family farms and ranches, and we're pleased to see legislation that aligns this aspect of the law with the real-world circumstances facing our members. So Farm Bureau is very grateful for Senator Weber's work on this, and thank you, Mr. Chair, for hearing the bill today.
Thank you, Mr. Peterson. Thank you, Senator Weber, for the bill. It's going to help us keep family farms on the land and operating. Senator Putnam.
Thank you, Mr. Chair. I have a question for Mr. Peterson, I think. Mr. Peterson, my understanding is that there are 36 steps that you have to go through in order to qualify for the Ag Special Homestead Exemption. Would you please walk through each one of those 36 steps for us?
Mr. Peterson.
Mr. Chair, Senator Putnam, I'm not exactly a full expert on all those tax aspects, but, so I can't answer your question, unfortunately, but I appreciate your interest in the details of that.
Thank you for trying, Mr. Peterson. Mr. Chair, if I may
Senator
follow
Putnam.
up just briefly. Thank you, Senator Weber, for bringing this forward. You know, we are definitely at a point where we need to really seriously think about the nature and definition of a farm family in law, because it's not the same as the farm family that's living. So making greater modernization and elaboration and understanding of what it means to be a farm family, I think, is a very important thing for us to do at this moment in time. And in fact, I'll be carrying a bill later in the session, hopefully. We'll have an opportunity to hear it, that changes the number, the arbitrary number that says what a farm family is now, which right now is 12, which is completely out of touch with reality for the rest of Minnesota, especially Stearns County. So we have another opportunity to talk about what it means to be a family farming in Minnesota agriculture today. So thank you for this bill, and I very much support it.
Thank you.
Thank you, Senator Putnam. Other questions, members? Hearing none. Senator Weber.
Thank you, Mr. Chairman. I have no further comments. I just believe, again, that this is an important element for the family farm structure in Minnesota. Thank you.
Thank you, Senator. With that, members, Senate File 245 is laid over. At this point, do either of the co-chairs have any announcements? Senator Rest.
Mr. Chairman, we'll be meeting Tuesday, Wednesday, and Thursday next week, beginning at 8:30.
Thank you. Senator Weber.
Thank you. We have 5 more bills on the agenda for tomorrow, and we'll see you at 8:30.
Thank you, members. With that, great discussion. Meeting is adjourned.